Alright everyone, Cowboy Trades here, welcome back to the channel for another update on the market. So, the Fed's tightening cycle continues as they raise the interest rates by 25 basis points from 5.25% to 5.5%. So in this video, I want to talk about everything which just happened in this FOMC meeting. What were the main takeaways from Powell's speech? We'll then review some economic data in which the Fed will be looking at to make their decision on the September meeting. We'll then briefly talk about what's happening in the cryptocurrency markets and wrap up today's video. It's going to be a quick one, so let's dive right into the content. So as I'm sure all of you know by now, if you don't know, make sure to follow me over on Twitter at 618_cowboy. The Fed raised their interest rates by 25 basis points up to 5.5%. In the previous month, they were pausing. This was leading a lot of people to believe that the interest rates were going to top out at 5.25%. As we've been discussing on the channel, reviewing economic data, looking at what's happening in the job market, look at what's happening in inflation right now, specifically with the month-over-month increases which have been happening in 2023. We think inflation's going to push back up. We think the job of the Fed is not done at this moment in time, and that is basically what Powell came out and stated in his speech. So the main takeaways from the speech were, number one, we are continuing to sell our securities. That is the definition of quantitative tightening, the opposite of quantitative easing. Number two, the full effects of the tightening cycle has not yet been felt. Number three, additional hikes may be necessary as soon as the September meeting. This is also data dependent. Number four, there are two more job reports and two more CPI reports until the next FOMC, so the Fed will be keeping their eyes on this data before they make their next decision on the FOMC meeting. And number five, the consensus of the Fed is that there will be no interest rate cuts in 2023. I want to follow this up by looking at the FOMC dot plot. The implied Fed funds rate is currently between 5.125% and 6.125% for the projection of the year-end Fed funds rate, also known as the interest rates. The implied mean rate at this moment in time is round about 5.4%. This can also be found over on the Fed futures chart in case you don't have a Bloomberg terminal. And the implied mean forecast for year-end from low to high is round about 5.625%. The dot plot fluctuates based on different Fed members' projections for the meeting dates. So this is basically just an amalgamation of all of them. This doesn't mean they're going to raise by 12.5 basis points. I basically take this as another 25 basis points following this meeting is on the table. Now, yesterday over on Twitter, I talked about the four main indices that the Fed was going to be observing before the FOMC today. Bear in mind, these are indices. The Fed also really has their eyes on the job market right now. That is also what they did state in today's FOMC meeting. I'll talk a little bit more about the job market in another video. I want to keep today's video a little bit short and sweet. Basically, the main indices they're currently looking at is core personal consumer expenditure year over year, the GDP deflator, core CPI, and also regular headline CPI. Now, we all know about CPI year over year coming to the downside. I'm really not going to talk too much about this because I literally made a 20-minute video on CPI bottoms in June talking about why I think CPI year over year is coming up. So I'm not going to spend any more time talking about year over year CPI. In terms of the rest of the indexes, core PCE has only dropped 15%, and there's basically been no progress made in the GDP deflator and core CPI. Now, the Fed love talking about headline CPI and how they're making so much progress. What they don't talk about as much, but they do state they have their eyes on, is, of course, core CPI. Now, this has really not dropped down too much. This is currently around about 4.8%. The Fed has implicitly stated many times we need to see softening in labor market conditions and we need to see core CPI come to the downside. Specifically in today's meeting, they stated that core CPI is a great leading indicator for headline CPI. So the fact that we haven't seen a major decrease in core CPI is definitely, of course, worrying for headline CPI. And also, in terms of the GDP deflator, this is something that typically the Fed always have their eyes on, but we haven't really heard the Fed mention anything about the GDP deflator, and that's probably because it's quite embarrassing to even mention the GDP deflator right now if you are the Fed. This is right now at 5.33%. Now, I've never mentioned the GDP deflator previously on this channel. I normally look at it in the Bloomberg terminal. I've never mentioned it over on YouTube. What I like about the GDP deflator ties into what I do not like about the CPI. CPI, which I have mentioned before, can easily be manipulated by changing the basket of goods, which encompasses the final result of the CPI. Now, different inflation cycles and periods of economic contraction leads the Fed to look at different indices, different markets. For example, right now, they're more focused on the job market than they typically are. However, in previous cycles, cycles, the Fed has stated these 4 indices are the main ones that they look at. So yeah, in terms of CPI year over year, some progress has been made. The CPI index, no progress has been made whatsoever, as we've been discussing on the channel. In these other indices the Fed looks at, core CPI, the GDP deflator, and core PCE, there's literally little progress being made right now. This is why I continue to expect further rate hikes will be necessary. The TIPS, also known as Treasury Inflationary Protected Securities, are arguably the 5th major indice that they do keep their eyes on. And at this moment in time, wow, yeah, the TIPS are not looking good. As we've been saying for the past 2 weeks, nothing's majorly changed. We are still retesting this major resistance on this bear flag, and we are very, very close to breaking into new bear market lows. This is a leading indicator of the equity markets and the cryptocurrency markets. If you watch the channel, you know all about this, so I won't spend any more time on this. The final thing I'd like to talk about in terms of the interest rates, the stock market, equities, etc., before we do move on to the cryptocurrency markets, is where the interest rates are at this moment in time. They're at 5.5%, the highest since the 2001 financial crisis. I've talked about this before, so I'm really going to breeze over it. It's very, very interesting to see how in pretty much every single situation where the interest rates were above 5%, the markets tend to be bullish up until the point where the Fed pauses the interest rates. As you can see, equity markets were rising throughout this period of high interest rates, and as soon as they got cut, it took a few months, but we then broke into recession. If you're wondering, these green vertical bars overlaid on my screen highlight when recessions happen in the US, and as you can see, these correlate to drawdowns in equity market prices. Now you can see over here, interest rates were rising. Earnings were still strong throughout the markets. The markets continued to push up as the Fed was tightening, and just as they paused and cut, there came the recession. If we look at this period, which is happening right now, you can see we had a mini blip in the recession over here as the Fed cut from 2.5%. We're more interested in the interest rates up here at 5%. As you can see, the S&P 500 is once again disregarding this high level of interest rates. I believe when the Fed pauses for a few months and cuts, that is when we're going to see the most amount of pain. A lot of people ask me in my cryptocurrency videos, a lot of people ask me in my equity market videos, in my altcoin videos, why do I believe the bear market is, far from being over? This is the main reason. If you look, it's not like the Fed cut and then the bull market just instantly comes back. Typically, you rally into phases where the interest rates are being raised. The interest rates then get paused for a few months or so. And then when they cut, that is when you experience the highest pain in the markets. That's when you experience the largest economic drawdowns. And that is why, my friends, I believe that we're quite some time away from seeing bear market lows in the equity markets and bear market lows in Bitcoin. This is really my main thesis behind why I think Bitcoin and the equity markets have not bottomed at this moment in time. Now, let's dive into what's happening in the cryptocurrency markets. In terms of the daily time frame, you can see Bitcoin is currently sitting right at the resistance, pretty much just on the line of the long-term moving average over on the daily EMA ribbons. We are looking pretty weak right now. If we do come over to the 4-hour time frame, of course, we've been discussing this tight range that we've been trapped in. We've broken to the downside of this, and we've made another bear flag. We are right now pretty much at the resistance at 29,500 approximately as of the time of recording this video. You can see we are getting stuck underneath the 4-hour EMA ribbons. Typically what happens after the FOMC meetings is you have a whiplash down and a whiplash up, or you have a whiplash up and a whiplash back down. These whiplash markets always happen around the time that the Fed either raises, pauses, or cuts the interest rates. Around the time of the FOMC meeting, you always have these major whiplashes in the market. So I kind of think we're just going to trend sideways for a little bit. We're then going to continue playing out this bear flag and break down to the downside. The price target of this is around about 27,600. We do also have a bear flag on the 4-hour time frame here with a price target to complete around about 28,250. So I mean, things are still pretty boring. Like I've said, I think this is ranging around the top of a bar pattern structure, and I think we're coming down to the neckline of around about 24,700. More about my price targets in just 1 second. I do also want to reiterate, this is one of the major topics that we talked about in the previous video that we posted 2 days ago. Right now, we could potentially be playing out a bearish MACD fractal. The last time in the bear market specifically that we had a bullish crossover in the MACD, this was not a sign that we were actually breaking bullish. This was a sign that we were overextended. Once the MACD flipped bullish, it only took about 2 or 3 data points before we flipped back bearish on the MACD. And once we flipped back bearish, you can see we had a large drawdown in terms of the price structure, which took us down to new bear market lows. since we had this flip on the MACD, a bearish MACD flip, which happened round about 40,600, we have only seen one further bearish MACD flip. This was right here, around about 27,000. We came down to 24,500, and the hopes of these ETFs being accepted by the SEC were basically what caused the markets to push back up to the upside. We were crashing. All of a sudden, all these institutions started filing for Bitcoin ETFs. The price rocketed back, double topped at this region over here. Since then, we've been turning to the downside. And if we do look at the weekly time frame over on the MACD, we are really 1 week away from having a bearish flip. So even if we continue trading sideways in this market structure, it will flip bearish. If we break down to the downside of this 4-hour bearish flag, then we are going to, sooner rather than later, either this week or next week, get ready for this bearish MACD flip. And the last proper one which happened, which was not manipulated by news events such as, Bitcoin ETFs being pushed out, was right up here at 40,400. And we did have a major crash. Besides that, of course, we did have one over here taking us from 27.5 down to around about 25,000. And once again, this was reverted by the hopes of the Bitcoin ETFs. Since then, the SEC has come out and said, we don't want to accept these ETFs as they are. They are inadequate. You need to refile them. You need to do different things, blah, blah, blah. It might be some time before we see any US Bitcoin ETFs accepted. So coming into what I think is happening in terms of the price targets, once again, like I said, on the 4-hour time frame, in the immediate short term, we're still looking at the same price target at 28,260. Following then, we have another bear flag price target at 27,600. If we do come over to the macro BTC chart, I do see us heading down to the 200-week moving average. This is the first macro price target, 27,200, in beautiful correlation with this 4-hour bear flag, round about 27,600. If we then come back over to the chart, this is a major support and resistance zone. In fact, we can actually drag this back a little bit further. Right here, from this wick, from these rejections, this was support, this was resistance, this was resistance, this was resistance, this has been flipped to support. I think we're coming back down to it, and we could potentially form a absolutely brutal M pattern structure if we do tear through the 200-week moving average, 27,200, coming down to the neckline at 24,000, and then at which point, if we do break underneath this zone, where could we potentially head down to? Well, we'll talk about the price target of the M pattern at some point in the future. I want to see a little bit more continuation on this before we really start talking about the M pattern. But where do I think we're really heading down to in the next few months or so? The CME gap all the way down here at 20,250. So there we go, my friends. Not too much to comment on in terms of the Bitcoin charts. We're still trending sideways. We're still doing a whole lot of nothing. I think we are getting ready for a rather significant move due to the fact that we are in a 4-hour bear flag at resistance on the 4-hour EMA ribbons, sitting on the last line of support on the daily EMA ribbons, and we are breaking down from this brutal bar pattern price structure. And I think we could be range bound for a tiny bit longer, maybe a few more days, maybe 24, 48 hours, etc. I don't have a crystal ball, but my price targets. I think we're getting ready to break down from this structure and head down to the 200-week moving average, the bar pattern price structure, and then of course come back down to the 20,000 CME gap. So there we go. That's all I've got for today, my friends. If I do see any potential trades line up over on Bitcoin, I will post them first over on my Discord. So do be sure to come and join the Discord. If you want to join, all you need to do is head over to my YouTube channel, click on the About section, and you can see links for my Twitter, Discord, merch store, etc. all in the link down below. I'll see you in the next one, my friends. That's all I've got for you today. It's been your boy Cowboy Trades. I'm out. Peace.